All right, guys, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, sizing up big tech, Meta, Microsoft. Those shares are falling sharply after their earnings today. Now we have Apple and Amazon looming even larger tonight. We will break it all down with the committee. Joining me for the hour today, Joe Terranova, Stephanie Link, Jim Leventhal. We'll take you to the markets. We'll show you exactly what is going down. Stocks are going down. NASDAQ's going down about 2.5%. Why? Because Meta and Microsoft are big drags. And other mega cap names are too. Let's start with Microsoft, which, as I said, is lower. CapEx up a bunch, weaker than expected current quarter revenue guide. Our news as it relates to us, beyond what you already know, because you've heard so much about this already, is that Jim has trimmed Microsoft. Now, why'd you do that?
Let me start by saying this. I don't think that any of us have to own any of these names. I understand they are very big portions of the benchmark S&P 500. I've been underweight Microsoft to begin with. This has had a terrible chart for quite some time. I don't think it's a terrible company, but it's simply overpriced. And when you get an overpriced company with a terrible chart that disappoints on forward guidance, it's hard to beat against that tide, so I'm trimming it. There's other places I want to put that money. We'll get to that later. But I just don't see a compelling reason to continue to own the stock, even in the small size that I have. Now, I still retain a small portion, but I'm kind of telegraphing that I may not own it forever or even for very long.
All right, so the stock obviously hasn't done well in 3 months, in the last 3 months.
Yes.
So I get it if you're looking at the chart on a very near-term basis and saying that it looks terrible, the way you describe it. Mm-hmm. You called it overvalued. Now, at Microsoft's most recent high, on July 5th, the PE, do you know what the PE was then? It was 35. Mm-hmm. Do you know what the PE is today? It's 29.5. It's 29.5. Do you know what the 5-year average is on Microsoft? It's 29.5. So I find it interesting that you declare it as overvalued because the multiple has actually come in from where the stock was. And it seems to me, from most of what I read from the street today, is that they feel like the story is getting a little more interesting, and that if you look at what happened in this most recent quarter, it makes some more excited to own the stock, not lighten up in it.
Good. Makes a market. I'm not going to back off of what I said. Small detail here, Scott. I'm looking at FactSet forward multiples 31, but the point still stands.
All right, it was 35.
Down from 35. Your point still stands. Now, the reason I like that you're bringing this up is because we should never be selling stocks just on a valuation call. That's a bad reason to sell a stock. However, as I said, this is a stock, and we've discussed it many times on the show, where the chart this year simply has not been good. It has not performed well with the rest of the Mag 7, so to speak. And, when you think about where the biggest growth is supposed to come from and where the highest margins are, it's Azure. And I'm just not seeing the love there in the forward guidance that I would need to see. So it's all of these things combined. But it also, Scott, allows me to come back to a point that I'm not sure I fully fleshed out when I started here, which is that the Mag 7, mega cap tech, whatever you want to say it, is not a monolith. We saw that Alphabet in its web services, its cloud services a couple of days ago did very well and projected very well. I happen to think that that will be the case with Amazon, and I know we're going to discuss that later, but that's where I'm adding money. And my point being is it is a stock picker's market, not only amongst sectors, but within sectors and within styles such as the Mega Cap 7.
All right, Joe. So Azure beat up 33% year on year. They do forecast a bit of a slowdown to 31 to 32%. Just to make clear what we're talking about, in the current quarter. How would you assess the earnings report? Stock's obviously down 5.5%. And what about Jim's commentary here that too expensive? Time to lighten up.
First of all, it's clear to me they have a capacity issue as it relates to the data centers. That's why they went out and did the deal surrounding 3 Mile Island. That will resolve itself over time. What's interesting just on Jim's remarks about the degree to which you own the mega caps. I had a colleague say to me this morning on a call, well, we've got Meta and Microsoft down, and you don't own them personally, and you own them in the ETF equal weighted. That's good for you. And I was like, how is that good for me? The market's going to go down just simply based on index weightings overall. So I think what we heard last night from Microsoft and the subsequent reaction where it's down 5%, number one, it bruises market sentiment, and number two, it begins to dent the overall prevailing bullish trend that we have right now. So I don't know in the near term how you can extrapolate what we heard as being good. I think if you want to sit and wait with this company and rely on their ability to have a very strong capital allocation strategy, I have no problem with that. It's something that I've done in the past and would continue to do, but I think it is going to resolve itself over multiple quarters and not specifically quarters we're going to see in the near term.
Okay, so we have a lot to get to, and we're going to get to Meta in just a moment, which is a drag as well. And Steph, I'm going to get to you in a moment too. But I do want to hit Uber because we made it our chart of the day as that stock is down and down significantly, near 12%. That's after gross bookings did miss. Their outlook for the holiday time period was fairly soft. Josh Brown joins us now by phone. It is, I think, still his largest position, if not the largest. It's right there with NVIDIA. So what's your assessment, Josh, of the quarter, what the stock is doing today?
So two different things. I think what the stock is doing today is sort of bizarre. I know that it's getting lumped in with all of the other growth stocks that are down. They just picked a bad day to report, I suppose. I'm looking at Robinhood off 17%, Uber off 12%, Coinbase down 10%, NVIDIA 4.5%, Meta 4.25%, Microsoft down. So it's just a lot of selling in tech and in growth stocks in general, and it's as they say in British soccer, unlucky. I would say it's one of the best quarters this company has ever reported. Net income was $2.6 billion, or $1.20 per share. I want everyone to understand that's versus the same quarter a year ago. Net income was $220 million and only 10 cents a share. So what this company has done over the last 12 months is really miraculous. The only fly in the ointment here seems to have been the gross bookings number, which quite frankly was not bad. I mean, if you just go by the stock price reaction, it looks like they dropped some sort of a bombshell, but it's quite frankly not the case. So they are, if you look at mobility, if you look at the Eats business, they are firing on all cylinders. And I think whatever we're seeing on the screen today, A, is an overreaction. We've retraced all of the gains back to September 12th at this point. And B, if this were a green tape for the NASDAQ, I think today's loss would probably be cut in half, if I had to guess.
You know what I find interesting, and before I let you go, because I know you got a heart out, and I appreciate you joining me, Josh, Joe sold Uber this morning, so I want to give the ball to Joe for a minute to explain that and get your reaction to whatever he says is the reason why.
Josh is going to completely understand. I own it personally. I've owned it personally since March of 2023. Bought it in the mid-30s. I've had a very levered position to Uber, owning it personally, and then the ETF owning it from January of 2024. So I've rode the momentum higher. I've ridden what has been very strong fundamentals. What did I not like about what I heard? It's what Josh talked about. It's the gross bookings. It's the guidance on the gross bookings. And it's very clear that now higher insurance costs are a challenge for this company. And the only way to resolve that challenge is to pass it through to the customer, which is going to be difficult. That's going to lead to a challenge in terms of pricing. So really, I'm working off what was a very levered position. It's still in the ETF. I own it through the ETF, but it's time not to own it in both places.
Yeah, Josh?
Joe's exactly right. Insurance was an issue, but Dara said, and I think he said it on our network to Andrew Rosorkin as well, that the rate of increase of the cost of insurance is going to slow relative to what it was. But yes, it's an issue. They're passing along that price to customers, and typical price elasticity rules. So when you price something higher, you're going to get less. You're going to get less bookings. As far as the numbers themselves on the bookings, though, I think it's really important. When people say soft bookings, that's actually a mischaracterization. These are the numbers. Uber provided a range for Q4 of $42.75 billion at the low end to $44.25 billion at the high end. According to Street Account, the estimates were 43.68. So the estimates are right in the middle of the range that Uber provided. I think it's smart for them to give, relatively tame guidance. And if they can exceed that, you'll see whatever, 6, 7 points taken off the stock, added right back. So I'm a long-term shareholder here. I respect Joe's decision. He's got 100% profit in the stock, give or take. I get it. I'm doing something different here. I think that this company has the ability to become, because of its TAM and how well it executes, to become one of those Mag 7 type names over time and totally dominate this category. And I want to be here for that. And look, I've been in the stock for, 5 years, 6 years. I've seen this thing cut in half. I've seen it have great earnings responses, poor earnings responses. This is just part of what it means to be a long-term investor as opposed to a trader, and I'm riding it out.
I appreciate you, man. Thanks for calling in.
All right.
We need to hear from you today. That's Josh Brown joining us. So, Steph, as we move from Uber, we take Microsoft in context with Meta. There obviously is, a diminishing tolerance for a very high spend if there's going to be any bit of declining revenue growth, even at the slightest on the margins. It still factors now into stories in ways that maybe it was given a pass before.
I mean, I thought Microsoft and Meta were both really good. I thought that Microsoft, AWS, those numbers, Azure, those numbers are really good. 33%, accelerated 1 percentage point. They're guiding a little conservatively, but you're still going to grow at like 31, 32%. So I understand they're spending a lot on CapEx and people don't like it. I also am not crazy about margins are down year over year and continues. That's obviously because they're spending so much. But I didn't think it was that bad. So it is on my radar screen. I haven't owned it for years. In terms of Meta, Meta was an excellent quarter. 20% ad revenue growth, which was better than the overall market. And they're seeing double-digit engagement from AI. So they are seeing monetization. The only problem with it, it's expensive. It's trading at 18 times EBITDA. When I was buying it a couple of years ago, it was at 9 times. And so I think it's fully valued. But again, if both of these were to pull back, these are long-term secular growth stories. They just got over-owned, a little overhyped. But I do think that there's real growth here that you want to watch out for. Maybe these are opportunities. I just think it's going to take a little time.
Zuckerberg making it clear that they're going to continue to spend. Our AI investments continue to require serious infrastructure, and I expect to continue investing significantly there too. Joe, they take the low end of their CapEx up to $38 billion. The prior was $37. $40 billion still remains their top end number. But he's telling, we're going to spend whether you like it or not, because we're already reaping the benefits of investing in AI, and we're going to continue to do so.
Yeah, well, Reality Labs had a $4.4 billion quarterly loss, but to Steph's point, the ad business was really strong. So you have to feel good about that, because why? The ad business is the cash cow. That's what's actually funding the spending. So I just think that the challenge for Meta going into this quarter is that it was the leader. It was the leader of the Mag 7. It had been outperforming, and really it was looking for a reason to correct. And I think last night you got the reason to correct, just with the concern related to the AI spending. I'm not sure that I liked hearing about AI glasses and the metaverse once again, but I understand that's part of the entire dynamic where he's spending on AI. But the businesses, the core businesses still look good. The ad business looks good. The consumer-facing businesses, Facebook and Instagram, they still look good as well. I just think this is nothing more than a technical reaction.
Okay. We do obviously have Amazon and Apple this evening, and let's do them in that order. Amazon, I bring it up, Steph, because you bought more shares of Amazon, correct? Why?
Yeah, so I bought some more last week. We've been talking about it for a couple of weeks now, that the stock has lagged. It's only up about 2% since they reported last quarter. The Nasdaq's up about 7% in the same time frame. People are concerned about profitability. They always are concerned about profitability. But I still think that there's other parts of the business like AWS that's going to grow and see acceleration. It's probably 19-20% this quarter. I think you're going to see acceleration going forward. They're the largest in the industry, so their numbers are going to look less good, if you will, than their competition, but that's still really good growth. And AWS carries 33% margins. Their ad business carries 50% margins. And I think between now and 2030, and I know it's a long time, but you're going to see like these two businesses go from 24% of total revenues to 35%, and they carry these high margins. So I think profitability actually is going to recover and improve in the coming years. And oh, by the way, I understand North America retail drives the sentiment short term. I think you're going to see upper single digit growth, but their margins are upper single digits. So that's why I think people are concerned. But I think the valuation, we've talked about this for a couple of weeks, it's cheaper than Apple and has better growth. And I do think their EBITDA is going to grow 20% CAGR as opposed to Meta growing at about 13% between now and 2030. So I like the risk reward of the setup, and I'll buy more tomorrow if it's down.
Okay. Jim, you bought more as well. You alluded to it earlier, but give us the reasoning here why.
Well, I will. It's a choice. It's a strong choice because, you know, if you think about what I just said about Microsoft and the valuation isn't really that different with Amazon. So why am I choosing this? Because think about what Alphabet did 2 days ago and what Microsoft did last night. They both have strong web businesses. One had a better projection than the other. So I have to decide which one I think is right. I think Alphabet's right. I think Amazon Web is in the same business, is going to have the same sort of results. On top of that, I think about the retail business, and I think about 3 months ago, the last quarterly report when Amazon got clobbered. And why did it get clobbered? Because of a bad prognostication about what the consumer is going to do. Since then, we've had very strong labor reports. We've had very strong retail sales report. And there's a little clue in Visa. Visa's report, it's a couple of days ago, had the biggest growth in card not present. That's terminology for online commerce. So that's where I think you're going to see a better than expected result as well for Amazon is the consumer, the retail. I put this all together, and at the same valuation, more or less, as Microsoft, I see a better prediction ahead for Amazon. I'm making a choice.
Okay, let's move to Apple, and then I want to move on to other stocks. There are a lot of interesting moves that we still have to get to from our committee members that I know you'll be interested in. Steph, so you've been trimming Apple. What was a large position is now reasonably small. There doesn't seem to be a tremendous amount of optimism going into tonight, nor is there a lot of high hope for guide for the last quarter of the year. How are you assessing this?
Well, I was buying it in May. I was adding to it. It got to be 9% of my portfolio by September, and that's a really big position for me. My benchmark is 6.5, 7. So I started to trim just because I'm up 37% just from that trade alone. I still like Apple very much for the long term. I just don't think that iPhone 16 is going to be the super cycle. I think 17 and 18 will, because AI will be more in their phones in terms of functionality. I also like the fact that there's 270 million phones around the world that haven't been upgraded in 4 years. So those are the positives longer term. I think shorter term, I think the stock is kind of dead money-ish, especially after the run that it's had. As I mentioned, it's trading more expensively than Amazon. I think there's better risk reward in Amazon. And I just feel like a lot of good news, like services growing double digits and margins expanding, I think that's kind of reflected in the valuation at this point in time.
Joe?
Jobs report. Big election on Tuesday, Fed meeting next week. I think tonight's report from Amazon and Apple is critically important in setting the tone. What is the tone going to be carrying into each of those events? Are we able tonight to hear enough from Amazon and from Apple to reverse what we have seen in terms of the price reaction to Meta and to Microsoft? We came out with Tesla, good earnings. We followed that up with Alphabet, very strong response. And now we've kind of offset that, and we're leaning more toward a negative response. I've always felt that earnings were most important here. As it relates to Amazon, AWS, I agree with Steph. I think that's incredibly important. And then looking at Apple, the revenue growth is the problem. The revenue growth for everything that I look at, the financial metrics that I look at, the company's growing at 2%. That's not consistent with some of the other Mag 7. That's a problem.
All right, so outside of the biggest tech names, there are other big names that we do need to get to. Steph, you bought more Eli Lilly after it posted its worst day since March of 21. You bought it for the first time.
Yeah, ever.
Tell me why.
I've never owned it before. It's always been too expensive for me. And I thought down 13% at the peak yesterday at the lows, I thought it was an opportunity to own a high quality franchise company. You know, this is the #1 player in obesity and diabetes, and they are growing their total revenues yesterday in their quarter 42%. Even if you exclude those two businesses, their legacy businesses, oncology, immunology, neuroscience, that's growing revenues at 17%. And so then I look and listen to the CEO on CNBC. I thought he was very confident in terms of the underlying demand for the obesity and diabetes franchises. And I just think it got way overdone. It's not cheap by any means, but I just think I can get the best in breed on sale, and I'll continue. It's a very small position to start.
Joe, you have it too.
It makes me feel great. A brilliant investor like Stephanie is buying the dip. And we talked yesterday about the price action intraday. I thought the price action intraday yesterday made the bulls have a lot of comfort. It basically rallied from the opening and recovered a lot of the loss. So I agree with everything Steph has said in terms of fundamentals. I think it's still set up in the right place as we move forward.
You want to take a shot at Amgen?
Yeah, listen, we talked again yesterday about this.
Had earnings, that's why I asked.
Yeah, but it's about Maritide, and you'll hear about Maritide as we push towards the end of the year. This was kind of uneventful, not very much here. I said yesterday, take your 2.9 dividend yield and get paid to wait. I think that's the right thing to do. Ultimately, they'll be the third player as it relates to obesity drugs.
Yeah. Steph, you also bought more D.R. Horton, a big housing play you've been on. It was, you're probably more bullish on that space than anybody.
Yeah.
This year it looked like an amazing trade for a while until yields started backing up, mortgage rates went up, and then these stocks fell like a stone. What now?
Yeah, stock is still up 10%, but I did not think it should be down 7% when it reported earnings. I don't think the quarter was good, so, don't misunderstand me at this point. But I do think the home builder EBIT margins were actually up, and that is important to me for the short term, because eventually the orders are going to catch up when interest rates come down. We are still in a deficit in terms of 5 million homes short in this country, and they've underproduced for the builders underproduced for 14 consecutive years with no plans of changing that. And you have 5 million millennials that are first-time buyers, and D.R. Horton, it's 57% of their book. It trades at 12 times earnings, so you have to be patient. I think it's a 2025 story where it really takes off. But, these stocks have done quite well over the last couple of years, and I think it's going to continue.
So you...
The argument on that is that, obviously, the cost of capital, rising interest rates is a challenge. But when you look at that, these stocks have done well with rates rising. And then you think about
because of the discipline.
But also think about existing home sales. So that gap between new homes and existing homes, I think it's at the widest since 1980. But if you've got the lock-in effect, where people that locked in before 2022, that means there's not going to be inventory. There's not going to be existing homes that are going to put on the market. So you need these companies to build the homes, actually. So
but they would rather buy back their stock than buy land. That's right. As simple as that. That tells you everything you need to know. And if they're buying back their stock and this company has a $4 billion program, I want to be buying with them.
Let's get one more move before we take a break. You sold Seagate.
Yeah, that's simply just to fund all these buys because I didn't have any cash. And I'm up 20%
cash
in the name.
All right, just to get a little more liquid, to make some more moves. All right, so let's do this. We're going to take a quick break, and when we come back, Bill Baruch is going to join us because he has a sale and he has a buy. And you're going to want to know in which space and what stocks he has made moves in. He'll tell you next. This is the final day, trading day of October. Financial is actually the best sector this month, up 4%. On that note, let's bring in Bill Baruch because he is making moves. It's good to see you. Let's do the buy first, which is Goldman Sachs.
Yeah, we added Goldman Sachs. I think in this environment, we want to have exposure in investment banking. We want to have exposure more in foreign currency and commodity trading. It's best in class, and it helps us overall between these two moves, helps us get exposure in more financial services. We really like this move, even though it's at a high valuation. The move itself has netted us a little bit of cash, and I'll be adding to Goldman Sachs more as it goes lower.
Why'd you sell Bank of America?
I think there's a lot of interest rate uncertainty here in this environment. And Bank of America came into the year what we felt undervalued. So we leaned into it for our banking exposure. During this time, Bank of America's rallied. We've leaned into JP Morgan. And net interest income, it really is a bit of uncertainty going into 2025. We don't want too much exposure in the banking space. So this helps diversify our book.
I want to get Steph's reaction to the Bank of America thing. So stay with me because I want you to react to whatever Steph says because you own Bank of America.
Yeah, and it was an excellent quarter with a lot of market share take, and there's a lot of ways you can win with this company. It's wealth management, capital markets, M&A, investment banking fees across the board. And So I think that the valuation is still very attractive. And Moynihan has said when Basel III Endgame comes out finalized, they are going to buy back a lot more stock, 20 billion or so plus. I think there's a plus sign next to that. So I like that very much. So I don't think you should worry about net interest income because there's a lot of other places that they can make the money. And I think 2025 sets up very well for net interest income and net interest margins as the yield curve continues to steepen.
And you don't care that Berkshire's lightened up so much in the name at all?
No, I don't, because just because of the fundamentals. He's probably up a ton, Scott, right? And he still owns a lot in terms of, I think it's still 10%, maybe a little under 10%. So, I'm not happy fighting against Buffett, but at the same time, I think that the fundamentals justify buying this stock even today after the run it's had.
Bill?
Yeah, I think Steph's made a lot of great points here. I want to get technical with positioning for a second since you brought up Buffett. That is a little bit of a fear of ours that there's been some selling, not because of that exact point, but the fact that Bank of America really hasn't broken out from a technical space. Goldman Sachs has, and Goldman Sachs is settling in above its previous record high. So we find that to have more tailwinds here in the intermediate term.
Okay. I appreciate you joining us with the update on both of those moves. Thank you, Bill Baruch. Jim Leventhal.
Look, I want to point one thing out, and Stephanie, I'm sure you're aware of this and have an opinion, that there are some regulatory inquiries, relatively new ones in Bank of America, about Anti-Money Laundering, Bank Secrecy Act, as well as some Consumer Finance Board inquiries about Zelle. Look, this could go either of two ways. Okay, this could be like Wells Fargo. I think I see a wry smile on your face because you remember Wells Fargo.
This is not Wells Fargo. No way.
Well, actually, Wells Fargo
disagree with you on
Wells
that.
Fargo actually sailed through this. I mean, it was a short-term blip in the stock price.
The asset cap is the problem with Wells Fargo, and that's going to get lifted soon. It has nothing to, I mean, these regulations, they happen all the time, right? You always hear these things. So I don't think that's a big deal at all.
The Wells thing was a little idiosyncratic, wasn't it? I mean, wouldn't you suggest?
What I would suggest, and I want to say this very seriously, is don't take it lightly. I hope that it comes to nothing. Don't take it lightly.
Okay, we will not. Thank you for the heads up. We won't.
Okay, you know what? I'll hang myself on this, okay? You want to know where it should not have been taken lightly? Was Citigroup.
Well, that's for sure.
That's for sure.
Okay, so like
Yeah.
I know what I'm talking about.
Okay.
Okay.
Hey,
We didn't
we're not fighting you.
I felt a little. I love you guys. I thought I saw three wry
I
smiles.
think
I will say one thing about Bank of America. Just look at the
You did.
valuation of Morgan Stanley. Monetize Merrill Lynch. They've got to monetize Merrill Lynch, Bank of America.
Let me switch to some regionals because J.P. Morgan has changed some targets. Yes, they do Wells, but they trimmed Truist by $1.50, okay, to $45.50. Fifth Third they raised to $49. You own Truist. So what's your read on that? And just I don't care about a price cut of $1.50, but
Neither
in
do
terms
I.
of regionals,
Neither do I. Well, you own regionals if you believe in net interest income recovery.
super regionals.
Right? Yeah, the super regionals, certainly. But net interest income is 70% of Truist revenues. So I have to believe that you're going to see a recovery in net interest income. But this is also a self-help story where they are cost-cutting and they are focusing on profitability and market share and investment growth and investment management. And the stock trades at 0.9 times book value. It gives you a 4.5% dividend yield as well. But you also know that I recently added to Wells Fargo when they reported earnings because I thought they also are a self-help story, a net interest income story. But they are doing very well in terms of market share take in investment banking, in capital markets, in wealth management, and they are buying a ton of stock. And again, that asset cap, if it gets lifted, that's like a really big deal. Their assets have fallen since 2017, 1%. The rest of the big banks up 42% asset growth.
Joe,
Think
quick.
about the catch-up.
Okay,
It's hard to find an industry that came into 2024 with the degree of bearish sentiment positioning that regional banks had.
Because you have Fifth Third, you have. I'm just to bring everybody up. Fifth Third, Citizens, M&T, and Synchrony.
Yep. Regions Financial, Huntington Bank as well. And the regionals have outperformed those bearish expectations. And to Steph's point, it's been about net interest income, but it's also been about stepping back and not realizing the apocalyptic forecast that was in place in the second quarter of 23.
All right. Let's do some calls of the day. We begin today with KLA because it was upgraded to outperform. That's at Oppenheimer. The price target bumped by $100, not $1.50. So I feel better talking about that. $8.50 from $7.50. They initiated it perform just last month at $7.50. So now they feel so good about it that they bumped it up even higher. They call it a favorable 6 to 9 month window opening. What do you think, Joe? You own it.
Well, I think the semi-equipment names, there's three of them: Applied Material, Lam Research, and KLA Corp. And those have been identified as the potential beneficiaries in this AI CapEx cycle. We're also talking about really strong companies. In the case of KLA Corp, I agree with this upgrade because you're talking about a company that delivers double-digit revenue growth. It delivers on free cash flow generation growth of nearly 15%. They're working through, and Steph knows this better than I do because she knows these semi-equipment names and has been around them for a very long time, but they're working through difficult comps. I think that's a lot of the challenge. And then there's also the China issue, which is beginning to show itself in a lot of the earnings. I think that resolves itself. I think they have a strong enough product cycle over the next couple of quarters that they'll be able to offset some of that weakness. And we saw this in the most recent report. So I think the upgrade's a good one.
Okay. Steph, remind me, because I don't see it on my sheet. You're not in Lam anymore? Is that why?
No.
Oh, you are? Okay, you are.
No,
So Joe is in KLA, you're in Lam, and Jim's in Applied Materials.
Yeah.
Make the case why Lam is better than the other two.
I think they're all good. I think they're all going to grow and increase market share from the smaller players. You have WFE, wafer fab equipment, is at the kind of the lows, if you will, right? So it's maybe mid 90 billion this year, probably 100 billion next year. That's a big driver to their overall story. I think Lam Research has done a great job in terms of margins and pricing power, and also just cost cutting in general. So they're more efficient. And so Lam trades at a discount to Applied Materials and to KLA, and I just think that's the better value, but they're all going to work. They all trade together.
I think, when you went through those three, and I agree, they're all, pretty good together, but you left out the big one, ASM lithography. And, well, I mean, I know you like to tease me, but it's kind of important, both because it's a big gorilla in the space, but also because it's underperformed terribly. That's the one the three of us don't own. And the reason why is because that vaunted monopoly is not coming through in the earnings, Joe, which you pointed out, because of China. So there are selections to be made, and not owning ASM is important.
Okay, Target, overweight Wells Fargo. Steph?
Yeah, I mean, this is the value proposition story. It trades at 15 times when Walmart trades at 34 times forward estimates. It's the widest gap. I think what they're doing in terms of product initiatives is working. Last quarter, we had 2% comp and 3% traffic. That's positive. Operating margins are expanding again. Inventories remain lean. I think they can earn $10 to $11 in earnings power next year. So we'll have to see, though. I mean, this is a tight time in terms of ahead of holidays, but I like it long term. I think Cornell is back on his game.
What about GE Healthcare, Steph? Outperform Mizuho.
Yeah, they had a good quarter yesterday. I mean, China was dismal, but it is for every company, med tech company, down 20%. But the U.S. was very strong. Gross margins and operating margins both expand. Free cash flow was better than expected. So I still like this one long term.
Okay, Mike Santoli. He's next with his midday word after this quick break. Let's go to Kate Rooney for a news alert. Kate?
Hey, Scott. Yeah, so this is about OpenAI. OpenAI is taking on Google's search engine with a new web search tool that was just announced in the last couple of minutes here. Shares of Google did turn lower on this news. You can see they're down about 1%. The $157 billion AI startup is rolling out what they're calling Search GPT. The company describes it as a way to get fast, timely answers with links to relevant web sources, which you would have, they say, previously needed to go to a search engine for. It's a big change. So you think of OpenAI really wowing users with its chatbot and ChatGPT for thoughtful answers and this ability to generate new creative content, but it could not tell you some of the really basic things like weather or sports scores. That is going to be changing. The announcement may also be the startup's answer to some of its publisher battles. New York Times and multiple authors have sued OpenAI for copyright infringement. In the release, though, they talk all about publishers. They say they're working with publishers and data providers to offer real-time information, things like stocks, sports, weather, and news. The list includes AP, News Corp, Axel Springer, Condé Nast, the FT, Reuters, and more. They also say any website or publisher can choose to appear in ChatGPT results. Should also say takes on Perplexity, too, which is one of the highly valued AI startups that specializes in search, but big news for OpenAI. Scott,
yeah, no question. Kate, thank you. Kate Rooney with the update on that. Interesting and developing story. Our senior markets commentator, Mike Santoli, joins us here for his midday word. I mean, this is just a great example of all AI all the time as we sit here and talk about Meta and Microsoft, and they're weighing heavily on this market today.
Yeah, and obviously to this point, it's never been considered a pure zero-sum game, right? It's a massive new market. Everybody's got to run as fast as they can to get through it. I think the reactions today on Microsoft, Meta, to me, it's not some kind of deep rethink of the overall story or the basic fundamental case for them or the overall market. It's kind of well, we didn't get any fresh reason to have a super high conviction raising of next year's numbers and all that. I think it happens at a moment when the unease that we kind of would have expected based on history and events in October is finally kind of leaking in a little bit as the election gets closer and earnings season kind of is a lot of give and take. Down to the 50-day moving average would be 5,700 on the S&P. I mean, this is still normal stuff. The equal-weighted S&P is actually down only half as much as the headline because of the big cap stocks weighing it. So I don't think it's really knocking the bull case off course, but it is, look, personal income and spending much stronger than expected. You do have this move in yields. It's not really caught a bid for bonds just yet. And I think, it's all just got to filter its way in, and 22 VIX is one way it does it.
Given the spending number that you just said, you had more data today as well. Does it make? I mean, GDP from yesterday.
Sure.
I think was what 2.8.
Yeah, PCE.
PCE.
Yeah.
What does that do to the importance of the jobs report tomorrow? Does it take away some of the importance of it because we know that on the the economy is pretty good?
It is, yes.
Pretty good.
I don't know about taking away. I think it's going to be an interesting Rorschach test because let's say it's as soft as the predictions of 100,000 or even worse. You're going to either be able to kind of write it off as storm effects and one-offs.
Seems reasonable. I mean, that's the noise going in.
Exactly. Or a bond market that has been under massive pressure could take it as an excuse to say, okay, maybe it's not super strong, and we can buy bonds here and yields can come in, and then you might be able to get some stability there.
All right, I'll see you in a couple hours. That's Mike Santoli. He'll join me later for his last word. Coming up, new record highs for a pair of committee stocks. We give you those trades next. Let's kick around some more stocks. Chenier, take a look at the chart. It's up 5%. Earnings, good quarter, Jim.
Just a solid company. It's interesting that they beat, and they did beat, and they raised guidance on EBITDA. The reason I say it's interesting is because so much of their business is already contracted that there shouldn't be this much variability. But there is. They have some discretionary portion of their business. They control costs. And, by the way, they raise dividends. I mean, this is just a solidly run company.
Eaton. They beat, but they're lower. Steph, you own it, right?
Yeah.
Revs missed?
Yeah, the stock was up 40% year to date, headed into the print. Some very high expectations. They did beat on earnings and revenue. And also, the Electrical Americas, their organic growth was 14%, with margins in this segment at 30.1%. Huge, huge, huge. And then orders were up double digits. Backlog also very strong. So I just think this is sell the news, and I think you want to buy.
All right. MasterCard is a new record high, so they're buying that one, Joe.
They sure are. All-time high this morning, although you got a little bit of an intraday reversal. Stocks now down 2%. Consumer spending strong. We heard that in GDP yesterday, and Visa confirmed it earlier.
All right, we got some winners, we got some losers. We're going to tell you about two of them on either side next. Want to trade a few winners, right? A couple winners, couple losers. Roblox, you see that stock today? Look at that, up 18%. Earnings beat. The outlook exceeded expectations. It's a new 52-week high. It's the best day since February of 23. And oh, by the way, the CEO is going to be on Power Lunch tomorrow. It's an exclusive interview. And you still have the Hindenburg story out there that Mr. Pizzucchi is going to have to answer to. And I know he's going to be asked about a lot of things around that report, about the metrics, user metrics, child safety issues, for example. So don't miss that interview tomorrow on Power Lunch. Carvana, new 52-week high there as well. And on the flip side of all this is Supermicro, which was downgraded today. It's having another bad day.
Good. It should be downgraded. We talked about this yesterday. I said it's a no touch. All right, so let's talk about the ownership. The ownership in Joe T is less than 0.5%. We're talking about somewhere around 42 basis points at this point. That's the advantage of being equally weighted because you don't incur the idiosyncratic single stock risk. The rebalance will be this afternoon. I want everyone to understand something. You have a quality control period of 3 days. So Monday at 4 p.m. was the last input that we had for the upcoming rebalance. But I'll be very candid. Whether or not it stays in the ETF, I would not advise the viewers to buy this stock, even with it down again today, nearly 14%. This is a stock that doesn't go in the penalty box. This is a stock that basically gets suspended for the season.
Okay. I'll stay with the analogy there. Estee is a new 52-week low.
Wow.
I mean, this one's getting run over by the Zamboni. All right, so you want to stay in the rink. You want to stay on the ice. I mean, Kramer was driving the Zamboni this morning.
I would love to buy something like this, right? I mean, it's best in class and it's on its butt, right? I mean, 4 out of the last 7 quarters, the stock has been down over 13%. I mean, that's remarkable. This was a top-notch company with a great management team, and now they've got a new CEO who's unproven, and now you're talking about $2 in earnings power for this company. I don't know what kind of multiple you want to pay for that. So I think it's a no-touch for now.
Okay. All right, finals. We do final trades right now on this desk. Stephanie Link, you have first one.
Chipotle, that was one I was buying yesterday as well, down 7%.
All right. Farmer Jim.
Transocean, look at earnings.
Joe T.
Get some volatility protection. VXX.
Thank you, everybody. I'll see you in a bit.